Good evening, everyone, and welcome to today's webinar on tax strategies, asset protection, and Indian properties for doctors. My name is Satya Hegde. I'm a chartered accountant and a CPA specialized in tax planning for medical professionals, helping them navigating complex tax rules, ensuring compliances, and making sure you grow your wealth. Agenda for today, let's discuss tax implications for around 20 minutes. Key tax challenges for medical professionals, why structure matters, how you can save taxes, and PSI, PSB, and the new tax rules with the asset protection. And we will also cover Indian properties which doctor owns. At the end, we have a 10 minutes of Q&A. Please drop your questions at a chat board any time of the presentation. We will address them at the end. Before we start, have a disclaimer. This presentation is not a tax advice. This is a general information. If you want any tax advice, please connect with your accountant, a financial planner, or a tax lawyer. We will be able to give you a customized solution. Please don't take this as a tax advice. So we are touching upon the first important point, which is a PSI and a PSB. I can definitely understand your situation. Very high taxes, a lot of non-compliances. Cash flow is a different issue altogether. Then there are some issues with the asset protection. While you're busy working in a practice, there is not enough time for family. And what we can address all these points with a structure, a proper planning, and how we can reach a much better outcome at the end. Now, what is PSI? PSI is a personal service income. Income derived from personal effort, skills, expertise of doctors. If you are a PAYG or a salaried full-time employment, then there is no risk for you. At the same time, you will be paying a very high tax, maximum tax rates at 47, 48. But the issue arises if you do a locum or you do a VMO or a part-time employment. So if you don't have anybody else working for you and it's all income generated out of your own efforts, then you may classify as a PSI. And 100% of your income will get taxed in your hands. Now, what is PSB? PSB is a personal service business, a legitimate business that meets the ATO test. Let us take, you're running a GP practice of your own. Like you order medical test. The ATO also has a test to determine whether you are a personal service business or a PSI, right? So I don't want to complicate this whole discussion. So what test the ATO does is a result test, an unrelated client test. That means you're getting fees from many clients, and employment test in the sense how many people you have in your team, and the business premises test. Do you have your own practice, or you work with within the practice and share an admin fee with them? So if you are in a PSB, uh, you're better off than the PSI. So how do we manage these two classifications? And one of the brilliant way is the family trust structure. So let's look at the family trust structure. What is family trust? Your family will be the ultimate beneficiary of the family trust. The entire business or a profession is owned by the family trust, which gives you idea for the income splitting and asset protection and estate planning. So there are negative points as well. There are a lot of responsibilities. There are some compliances which you need to be looking into. So, asset protection point of view, I would like to highlight two areas here. And I also have a small diagram about how this family trust works. There are two risks which you encounter. One is a patient doctor risk, which can't be eliminated completely. That is where your indemnity insurance is going to take care of it. Then there is another risk called the financial risk, is that the patient pays to you as a sole trader or patient pays to you through a family trust. That means there is another layer of protection in case there is any legal suit at the later point of time from the patients. So that is what we are trying to uh, save you from uh, the legal suit in the family trust. Estate planning is totally a different aspects altogether. If your if you are planning to join hands with somebody else. So it is a really a good idea, and the brand remains same in your family trust, and it can be a very good tool for asset protection and the estate planning purposes. So let us look at the diagram at the next slide. So this is how typically the family trust works. If you are in a GP practice, what we say is a service trust, medical service trust, or a family trust, or a unit trust. So these trusts is usually controlled by the PTY Limited as a trustee and can be owned by the single family or multiple family. End of the day, your family controls the entire trust and your family enjoys all the distributions from the business. So, what are these new rules? If you haven't changed your tax structuring after 2022 changes, this is a good time that you revisit your tax changes. 2024, there are new draft rules for the doctors that has not been passed in the parliament. So let us not complicate it further. The ATO is trying to crack down on service agreements and also looking into what percentage of income uh, you're distributing and what is your profit sharing. So there are some issues with the incorrect classification. Continuing to that, the third important point is that if we are going to do a restructuring, then restructuring cannot be done just to save taxes. So there should be some justification for restructuring. The justification could be in your asset protection. As we discussed earlier, you don't want somebody to sue you directly as a sole trader, and you want a kind of an extra protection from the patients suing you directly. So improved operational efficiency, in the sense the family trust is much better compliant in terms of taxes, in terms of how you can attract a better talent in your GP practice, or you can build as a brand name that can definitely help you with further retirement or joining hands with other practices. So that's a lot of operational efficiency there. And all this has to be backed by the contracts and agreement to make sure that the restructuring is done correctly and you are compliant in both tax rules, which is allowed by the ATO. And one other thing I would always emphasize is that about a commercial benchmark. Just to give an example, if you're a psychiatrist and you're earning around $500,000, then with all the structuring and everything, the benchmark salary, the current salary in your area could be $450,000, and if you are getting only $400,000, so that is where the problem arises. So always get a commercial benchmark salaries to be paid to the doctor. So the area of focus, as I discussed earlier, why it can be classified into three areas where you're high risk, low risk, or a medium risk. It depends on how much of the income which you have diverted to the other family trusts, and also a profit sharing, what kind of profit sharing ratios which you have, and the effective tax rate, how much tax you pay. If you're paying 48, absolutely no risk there. And if you're paying 40, then you'll have to justify why you're paying 40 with a proper structure in place. The incorrect trust compliances can be a critical issue as well. We have now we are moving into asset protection, and also I'll cover the Indian investments along with this. So all of us hold primary residence in our name for the simple reason that the primary residence is a capital gains exemption. So if you sell your property, you sell your primary residence tomorrow, you won't pay any capital gains tax at all. At the same time, you're going to hold primary residence in your name. That is your biggest asset by far. So if any legal issues happens, then your primary residence also will come into picture. That can be a really costly mistakes to have. And the tax lawyers offers different solutions to the primary residence. One of the major idea which they discuss is about gift and loan back strategies. So please talk to the tax lawyers about it. And the second point is a negatively geared investment properties. If you have a negatively geared investment property, it's a great, you can set off against your income, which reduces your tax liability. At the same time, you're holding such a big asset in your personal name, risking the asset protection for a very simple few $1,000 negatively geared tax benefits. So is it worth it? Is it worth holding separately in the family trust? So these are the important questions which you will have to think about. Then I would like to highlight on the Indian property side. If you might have owned, all of you, I'm sure that you must have been owning your property in India. Either it is owned investment property or inherited property. So most of the time, it's in our individual names. Does it make sense? So is there a HUF, the Hindu undivided family structure, or the family trust structure works, and that can have a greater asset protection for Indian properties. I have some more details in the following slides about the Indian property. So, as you might know, as Australians, we need to pay taxes for our global income and global assets. So, when it comes to income, if you are getting a rental income, interest income, dividend income, everything needs to be disclosed in your Australian tax return. And similarly, if you are selling your property in India and you have to pay a capital gains tax in India and you have to pay a capital gain tax in Australia. However, um, there are um, there are exemptions available. So there is a dual tax exemption. If you pay any tax in India, you can claim as a foreign tax credit. That is a great ways to reduce your tax liability. And please be mindful that you have to time your sale properly, because you shouldn't be selling it in April, May, June, which is an overlapping financial year, and probably the December is the right time for you to sell the property. That is where you can see a maximum tax benefits, as well as you can repatriate the funds quickly to your Australian bank account. So just to summarize what we have discussed in the earlier slides, so misclassification of PSI and a PSB, and ignoring a tax residency rule, which is mostly applicable for newly migrant doctors, and foreign tax credit, which we have discussed about the dual tax exemptions. If you have paid any taxes anywhere in the globe, you can claim that with your Australian tax return. You have to do it right. And the international fund transfer can be really, really tricky when you repatriate or when you get your funds from India to Australia. What happens? You classify it as an income, or you classify as a gift. So, or it can be classified as a loan. So you have to be very careful in international fund transfer. And many of the cases, this needs to be disclosed properly in your tax returns, and your bank deposit and your tax return will have a big mismatch. That is where it triggers, audits of the ATO. Failing to plan your CGT exemptions on a property sale, and one other important point is about the payroll taxes. Payroll taxes is a really a complex issue at this point of time for the doctors. If you're a GP practice, then you have 80% to 70% threshold for bulk billing, um, and it all comes down to the number, what kind of bulk billing patients you have, and you can be out of payroll tax. But at the same time, make sure that you are properly compliant. Otherwise, it can be a costly mistake. The payroll tax is upward 5%. And same case when you are a part of the practice and where you pay an admin charges for the practice. And if you have a proper structure, make sure that they are payroll compliant as well. Otherwise, it can be difficult to comply at the later point of time. They have some kind of an exemptions now, and they will start enforcing it later. And other point which I would like to highlight here is the EV cars. If you buy an electric car in your family trust or company, you can claim exemptions for tax purposes. But the EV cars exemption is not applicable for sole proprietor doctors. So please be mindful of that. And just imagine if you are using a petrol car, you can claim only business expenditure, not your personal travel. But in case of an EV under family trust or under company, you can claim the 100% of expenditure of a EV car, which results in saving around $6,000 to $8,600, depending upon which car you drive. And you structure it properly so that you get an FBT exemption. That is a saving which you do year on year at this point of time. The practical strategies are, how you can become a PSB with your current status, and utilizing the family trust in the most tax efficient way to make sure that you are compliant at the one side, and making sure that you use a tax planning strategy for your genuine practice. And the property sale timing, which we have already discussed about. The final and the fifth and a final point, which is about a superannuation retirement planning for the doctors. As you may know, that contributing to super, it is taxed at 15% instead of 47, 48%. It can be a great way to save the taxes. And if you haven't contributed in the earlier year, now we have a 30,000. Earlier, we had 27,500. Then you can do a catch-up contribution and save tax for this year. And SMSF can be a really good vehicle as well, but you have to talk to the financial planner about it. And you can buy properties in a SMSF, and buying SMSF commercial properties or your own GP practice is a great idea, which you have to talk to your financial planner. And there are some recent changes on the superannuation, which is not passed in the parliament. So let us not discuss at this stage. I have some more points with respect to Indian taxes and Indian properties. Make sure that you disclose all your Indian income in your Australian tax return. The one important point about asset, in your ITR, there's a clause number 20. If you have properties in India, you must disclose it here in the Australian ITR. And from an Indian compliances point of view, you can't have a savings account. You always need to have an RO account. An RE account is not required. And log into your income tax portals and find out if there is any tax notices or anything pending. At the same time, lodge your tax returns if you have rental income or any other income. And I often get asked about PAN and Aadhaar. If you have an Aadhaar, well and good, you can go ahead and link it. If not, we are not required to have an Aadhaar as a foreign citizens. So we do often a customized tax structuring, and just to understand your situation, make it tax compliant, try and reduce the tax rates, and structure it in such a way that your cash flows also improves. There's a bit of a peace of mind that you're compliant, with a better tax strategies, and a bit of a peace of mind as well, right? So we also maintain bookkeeping and compliances, lodging your ITRs or your trust returns. Make sure that you're compliant, and we will have a very proactive service in terms of reaching out to you, reminding you as and when required. Navigating locum and VMO can be a little difficult. If you have an Indian properties, we can help you with tax strategies and what do's and don'ts and everything. Just avoiding all the last minute scramble for compliances, making sure that you're compliant throughout the year. And we also help maximizing billing and Medicare claims for the GP practices. Just look at your data in BP software and find out Is there something which you can do in terms of upselling or anything else? This is really great. I would also like to ask what kind of tax issues are affecting you the most at this point of time. Just type your questions in the chat box, and I'm happy to answer your questions. And at this webinar, we have half an hour free consultations to attendees here, and this we are offering it for the first 5 clients. Just drop a message in the chat bot. Also, my team is going to share a meeting invite where you can book the slots when it is suitable. Also, you can reach out to my team and they will organize half an hour free consultations without any obligations as such. So thank you once again. Now let's focus on the Q&A. I'm happy to answer your questions and let's take it one by one. Thanks once again.